Alrighty, today we're going through three Texas multifamily deals. All of them are fully occupied or at least 75% occupied, and they all have income already in place. This is the Texas deal list. I'm looking at these through the lens of either an out-of-state or an overseas investor, somebody who wants cash flow, they want strong tenant demand. Let's go ahead and get my screen shared over here so y'all can see. And they want to go ahead and make sure that the asset is actually like going to be a strong performer for them for their portfolio. Let's see, where is this gosh darn screen? I want to share this one here. So we're going to start off in Baytown. Baytown is a suburb. I'd call it a suburb of Houston. The market here is actually incredibly attractive for long-term tenants just due to oil and gas industry. But this was one where we actually have, it just posted about 18 hours ago. This is one where all of the units are already tenant occupied. We already have the rent rolls for these. This is one I want clients to be a little bit careful with. It's the classic example of something that looks absurd on paper. Like, look at that. It's a 21.7% cash on cash return. Almost always, as your cash on cash return numbers go up, as your cap rates go up, those are directly correlated with the amount of risk you're taking on with the asset. So the risk is going to go up. I think this is an incredibly risky deal, but I also think that for the right operator, somebody who is not necessarily risk prone, what's the opposite of risk averse? Something like that. Somebody who's okay and comfortable with risk, this could be an awesome opportunity. It is fully occupied. It is pulling in right now. It's pulling in $64.50 or $64.45 per month gross income. They're also collecting another about $100 every month as like a utility chargeback, a ratio utility billing system that they use, a RUBS program. So there is a little bit of a kicker there, and you'll actually see that reflected here. It's almost a wash because we balance out the utility bill right here in the utility expense. So it was built in 1938. Old, not usually the things that we send. Fully remodeled in 2026. Now, fully remodeled can mean a lot of different things for a lot of different people. So be a little bit careful with that. We have done a deal with this seller in the past. They are very open to seller financing scenarios. So this is something that you could go ahead realistically move forward with about a 10% down payment. And it would be relatively easy to close in terms of the seller financing component. I think the reason why they're offering seller financing is because it's going to be very difficult to get conventional financing on it. But that's me not knowing anything. That's just my read on it. All right, here we go. So it is fully occupied, and nice that they did this. They actually included the rent roll right there, like on Zillow, on Redfin, whatever you use to go ahead and review your deals. So you can see what the rent rolls were. And then you can also see the utility collection just for the last 3 months since they've gotten it fully occupied. So this property is one where it is actually performing at this level. This is also one that has a really checkered past in terms of its listing history. So this thing has been on and off market since 2023 in various states of occupancy and various states of repair. It looks like the seller had purchased it about 3 years ago with the intent of wholesaling it, just flipping it back to the open market. They couldn't get anybody to buy it. So then they ended up doing a little bit of renovation and tossed it back on market, and then it didn't sell. And then they ended up doing a little bit of renovation and leasing out a unit and tossing it back on market for $650,000, and it didn't sell. Then it failed. It came off of market, went pending, back and forth like a lot of these things do. But now it's back on market again for $550,000. I think the $550,000 price tag is going to be too high for this product type. I also think that you could get pretty aggressive with an offer here and come in closer to this $450,000 number. And if you're at that 450 number, I think you're walking in tall cotton there, especially given that there's over $6,000 a month in rentals already coming in. Of course, you have to make sure that the rentals are actually performing. Just because something says it's pulling in $6,000 a month on the rent roll doesn't mean it's actually pulling in that and it's hitting your bank account. You actually have to get the money from the tenant. So keep all that in mind. Next one, what are we going to go through next over here? All right, here we go. Next one is actually a pair of duplexes. I've seen this one off and on a couple of times in Dallas. And this is the property that probably has the cleanest cash flow story on the list. As your cash flows go up, it always gets a little murky. Why is something that is producing such high yield, why is it actually selling? So that's something that we really have to sift through with each one of these deals that we send out every day. So the price target on this one is $650,000. The leases, it's fully occupied. The leases average $1,775 per door, and that puts total monthly income about $7,100 per month on a $650,000 strike price on a property that is in Dallas proper. So I'm going to go ahead and share my screen so y'all can see it. This one is just directly south of downtown Dallas. So you're very close to pretty much every name brand district that you can have around Dallas, around Bishop Arts and Deep Ellum and Lower Greenville. They're all going to be very close. Cash on cash, 7.3%. And I think a lot of that, like a lot of the reason this cash yield is lower relative to the rent to price ratios is because you've got a higher utility bill. I don't know why that showed up on the P&L, but it's there. This is fully not occupied. Well, it is fully occupied, but it's also fully furnished. So this is being leased out as a fully furnished long-term rental. It was also ran as a short-term rental for a period of time in the past. And with World Cup coming to Dallas, that could be a really interesting angle for a deal like this. So it's been listed in there for $680,000. Realistically, I think it's going to sell closer to $650,000. And something else that's important to look at with this one, zoom in here in terms of like lot lines, and you can't use these lot lines and treat them as fact, but take my word for it. This one is, these duplexes are actually split between two lots. So if you wanted to go ahead and close this, either your lender is going to have to be a direct lender, not a broker, or they're going to have to be okay with you purchasing this and putting both of these lots onto a single loan. Most people are going to have to purchase these as two individual transactions, which is probably going to nix any kind of house hacker, anybody buying with a low down payment financing strategy. It's probably going to nix this one from the list. But if you're a conventional investor just looking for high cash flow and very close to downtown Dallas, like look at this, very close to downtown, this could be a great option because it's fully furnished. You've got multiple leasing strategies, whether that's midterm rentals, furnished long-term rentals like it already is, a traditional long-term rental model, or if you wanted to go into an Airbnb style deal, this could be really attractive. So I think that one is pretty cool just in terms of multiple leasing strategies and the fact that you can leverage this in a lot of different ways to fit your portfolio as like markets change, as times change, as your needs as an investor change over time. Next one over here we're going into is student housing. How do we feel about student housing? It's a touchy subject. Some people love it. Some people hate it. Most people, when they first start looking at real estate, student housing is the first thing that they think about, because think about the last time that you rented an apartment, or the most consistent time where like a demographic of people is expecting to rent an apartment, and that's university. Like that's going to be your first apartment. That's going to be the first time where you're living on your own, paying rent. So Stephenville is home to Tarleton University. Tarleton has actually been really on the upswing in terms of their athletic program, their academics, enrollment. They've got about 21,000 students now at that university. So it's not something to ignore. It's really had some excellent growth. And this thing, there's limited housing supply. This quad, I'm gonna share my screen so y'all can see it. This quad is 100% occupied. There's a sister quad that is also 100% occupied. So you can purchase either this one, or you could do a pair of them. If you wanted to go ahead and pick up 8 units that were fully occupied. And here's the conversation again about cap rates and cash on cash returns relative to risk. As your cap rates and cash on cash returns go up, they are directly correlated with the risks that you're taking on, whether it's asset quality risk, neighborhood risk, tenant variability. Lots of different types of risks are reflected in these little numbers, these cap rate and cash on cash return numbers. So when you see something and it says it's at a 6 cap and it's at a 0.5% cash on cash return, it's a much lower yield on paper, but that also means it correlates to a much lower risk profile. This is going to be the type of deal that's good for an out of state or an overseas investor, probably somebody who's coming in via a 1031 exchange and putting 100% down, buying them in cash. Somebody who's going to come in and buy it and say, I'll do 1.2 for the entire portfolio, and they'll have 8 fully occupied student housing units, literally 2.5 blocks from this 21,000 student university, which is insane. So I think you'll have built-in occupancy year over year. You've got a huge growth tailwind in terms of appreciation potential with how fast this university is growing and the quality of growth in that university. And then the housing stock is relatively new. Look at this. It's a 2008 build. Very hard to find in any kind of like major downtown area, these more recently constructed assets. So I think this one is absolutely awesome. I love it as a student housing play. I don't usually push student housing just because they're hard to find at any decent cap rate. Not that this one's like going to knock your socks off with cap rate. It's a 6 cap. But still, in a student housing community, 100% occupancy, totally turnkey, opportunity to pick up 2 of them, it makes this one a really awesome property. And I think more so than any other metric here, it's just the fact that Tarleton is growing so quickly. And every single year for the last 6 years, they've increased enrollment year after year after year after year. Their athletic programs, and it doesn't even matter if you like athletics. Athletics are a great sign of financial health for a university. Their athletic programs are increasing in national notoriety. They're bringing in some really like awesome name brand athletes. So I think there's a lot of upside here, at least for the next 10 years in Stephenville. And this could be a great one to offset your carrying costs, let you take advantage of that appreciation and get that cash flow to be more aggressive over time, knowing that your worst case scenario is you have a break even asset in a highly desirable market. So I think that was pretty interesting. Let me know what you guys think. I send out this deal distribution every weekday. So it goes out every Monday, Tuesday, Wednesday, Thursday, Friday, usually between 7 a.m. and 8 a.m. And we cannot wait to work with you guys. Thanks.